for the next 12 months? And also, Jeff, if you have any trading ideas or investment ideas, feel free to share them with us.
Absolutely.
Fantastic. Take it away.
Great. So for those of you who don't know me, I'm Jeff Huge. I'm Chief Investment Officer of JWH Investment Partners. We're a single family office. My side hustle is publishing research. I'm a Wall Street guy. I worked for two of the largest investment banks on Wall Street for 25 years as an equity trader, as an institutional equity salesman, covering some of the biggest institutional investors in the world. And I became a publishing analyst. And I was hired by one of my clients to go work at a hedge fund. And I worked with a hedge fund manager by the name of Steve Luthold for a number of years, running a global macro fund. And when I retired in 2018, I basically set up the family office just to run my own money. I started getting so many inquiries from former clients, associates, et cetera. I just wanted to know what I was doing in the market. What did I think of the market? What was I trading in my own account? So I started putting together this deck, and I called it Alpha Insights. These are the trades that I think will add the most alpha to your portfolio. Well, it kind of took off, and now I've got hundreds of institutional clients that pay me for this research, believe it or not. But my biggest, I guess, joy of doing this is really sharing my my research and my conclusions with people like yourselves, basically family offices just like me, so that you can benefit from the insights that I find in our research. We do it a couple of ways. We have the institutional service that you could subscribe to. We also publish an investment newsletter called affectionately Huge Insights, the Big Picture. We just published our 28th issue, so we've been doing it for 28 months now. You can find this on Substack at hugeinsights.substack.com. It's now a top 200 Substack publication. So we just put the latest newsletter out on Saturday, so it's fresh off the press. So check it out if you're not already reading it. Where I'd like to start is really with the elephant in the room. The national debt is now approaching $34 trillion. According to the Congressional Budget Office, the U.S. debt to GDP ratio is currently over 100%. That's just looking at publicly held debt. If you look at all the debt that's on the U.S. Government's balance sheet as well, it's closer to 122% of GDP. And, it's projected to grow over the next 30 years to 180% of GDP. Now, research published by Reinhart and Rogoff conclude that as a country's debt to GDP ratio approaches 90%, the GDP multiplier effect of each additional dollar falls to about 1. And above 9%, that multiplier turns negative. And, this is as the U.S. is running a $1.7 trillion fiscal budget deficit with full employment, no less. So that's an issue. The other issue is the deficit. This is debt's evil twin, we call it. This is, according to research produced by the Aspen Institute, the 2023 fiscal budget deficit is projected at about 6% for the year. And, like the debt, the budget deficit is projected to climb much higher over the next 3 decades. They expect it to reach 10% of GDP by 2053. That's 30 years from now. Now, the fundamental cause of this steep increase is really that under current law, government spending to fund entitlements is expected to surge as the proportion of the U.S. population over 65 rises from around 17% today to about 22% by 2050. The other issue that's on my mind right now is core inflation. It remains sticky. Monetary policymakers have historically used and monitored a whole variety of underlying inflation indicators in order to gain context about long-term inflation trends. The Atlanta Fed publishes a dashboard, which is a really great tool that creates kind of a comparative analysis of all these various measures. There's about 9 of them, and there's 9 Federal Reserve banks, and they each kind of have their own. What it does is it gives the Fed a little bit broader characterization of retail price pressures from this dashboard than they can by just monitoring the movements of their favorite, which is core PCE, as we all know. Well, while all of the 9 measures are now printing below levels that prevailed a year ago, the current message from the dashboard is that core inflation is still approximately 250 basis points above target. If you look here in the in the white circle, this is where we are today. If you look in the red circle, this is where we need to be across these measures if we're going to be at 2% on the core PCE. The bottom line is this. We think it's very unlikely that the Fed will reverse course and begin cutting rates anytime soon, unless the economy goes into a hard landing recession. And that's part of our case. We're looking at the most severe rate cycle in 40 years. Monetary policy environment has really shifted from a 13-year period of aggressive accommodation to one that is now highly restrictive. And so far, the Fed's raised its funds rate 11 times over the past 20 months by a total of 525 basis points. And according to the consensus right now, the view has now shifted to reflect a 99% probability that the Fed's going to remain on hold at the December 13th FOMC meeting, and more or less on hold until March 20th, when they're now expected to begin cutting rates according to the CME Group's Fed Watch tool. Now, as all will know, the Fed has been increasingly vocal. There's upwards of 8 to 10 Fed speakers every week these days. That is the most transparent the Fed's ever been. The only problem is the message is conflicting. Some of the Fed governors are hawkish, some are very, very dovish. We've seen several Fed governors, along with a number of well-regarded business leaders like Jamie Dimon, recently espousing the view that the terminal rate may actually be well above where people believe that it will be. And so, in fact, Jamie Dimon's held to this conviction that it could go to 6% eventually. Well, one of the things that leads us to believe that that's not probable is the fact that liquidity is being drained from the economy at a geometric rate right now. This restrictive interest rate policy that we've been in is being augmented by the fact that the Fed's been allowing their balance sheet to run off since April of 2022 at a rate of about $95 billion per month. This is a quantitative tightening process. And even despite the $400 billion liquidity backstop that was created to arrest the banking crisis last March, they have since reduced the total size of their balance sheet by about $1.2 trillion from its peak of $9 trillion. Now, as a result, real M2 money stock in the US has been declining very rapidly through month-end October, and this data is reported about 30 days in arrears. It's now declining at a rate about negative 6.3% year over year. That's actually the second fastest year over year monthly decline on record, going all the way back to inception of the data back in 1960. The lowest was actually just a few months ago when it got down to a 9% year over year rate of change. At the end of the day, the Atlanta Fed estimates that the current rate of the QT that's currently underway is estimated to take out about 2.2 trillion over the next 3 years. That equates to an approximate 50 basis point increase in the Fed funds rate from where it is today. And so, we think there is really more tightening in the market than most believe. Another issue that really has us concerned is bank lending. It signals a recession ahead. The widely discussed impending credit crunch has already arrived and appears to be in full swing right now. According to the quarterly U.S. Senior Loan Officer Opinion Survey, the SLOOS, over about a third of those lending officers see tightening of credit lending standards for C&I loans. Meanwhile, loan volumes have declined by about 20% since last spring, when the collapse of four very weak banks, we all know who they are: Silvergate, Silicon Valley Bank, Signature Bank, and of course, First Republic Bank. These led to a sudden withdrawal of about $105 billion in bank deposits. And as money has been seeking higher yields, banks have been attempting to stem the tide by offering more competitive yields on their jumbo CDs, but it appears to already be too late. I think the bank run has already been contained, but depositors continue to be walking nonetheless, moving cash from demand deposit accounts to much higher yielding money market accounts and T-bills, where short maturity treasury securities offer safety, liquidity, and yields of between 5 and 5.4% right now. So to be sure, the decline in funding sources and riskier collateral are definitely tightening lending standards, but it's also the rise in borrowing costs that have curtailed new loan demand as well. So we've been following the LEI index signals, and that is showing signs of a recession ahead as well. The Conference Board's leading economic indicators, which again is reported with a 30-day lag, saw the year-over-year rate of change decline by 0.8% in October, and the LEI is down over 6% over the last 6-month period ending October 23. So, it's a slight improvement month over month from September, but the current level of the index actually signals a recession at some point in the next 12 months. The LEI's got a 100% hit rate when it comes to anticipating recessions, and the trigger typically occurs when the index's annualized 6-month growth rate trends below negative 4.4% for at least 2 consecutive months. This most recently occurred in August of 2022, and it's remained below that trigger level ever since. And based on data going back to 1970, the lead time has historically ranged from 6 months to 18 months. We are very, very close to that 18-month period right now. Finally, the yield curve is signaling recession is on the horizon as well. The 10-year 3-month yield curve spread remains inverted by about 108 basis points, but that's up significantly from its nadir of negative 215 basis points last April. That was the worst in over 40 years. That inversion between the 10-year and the 2-year Treasury is also steepened dramatically to about negative 45 basis points. And that's from its low of minus 106 basis points in June. Now, an inverted yield curve has preceded each of the last 5 recessions by as few as 10 and as many as 33 months. But, we consider that more of a shot across the bow. It's actually when the curve begins to re-steepen, as it has, that the torpedoes are in the water. So we think this is just another signal that we should be very concerned about a hard landing ahead. The final signal that I want to point out is that unemployment trends are also beginning to point to a recession ahead. And this is kind of the last domino to fall typically. If you look back on November 2nd, when the BLS reported non-farm payroll employment, it grew by just 150,000 jobs during the month of October. And U3 national unemployment rate actually increased to about 3.9%. That's up 50 basis points from the cycle low of 3.4% back in April. Now, economist Claudia Sam, who was formerly a Federal Reserve economist and was also on the Council of Economic Advisors, she developed an indicator for determining when an economy has entered into recession. It's become known as the SAM rule. And, the indicator signals the start of a recession when the 3-month moving average of the national unemployment rate, that's U3 unemployment, rises by a 0.5 percentage point or more above its 12-month low. The SAM rule has triggered about 1 to 3 months into the last several recessions, with the beginning of each recession retroactively determined by the NBER. The model has been praised for its simplicity and historically low rate of false positives. Well, the current reading is 0.33 percentage points, and that's up from a 12-month low of negative 0.07 percentage points. So we're already 40 basis points off of that low. Another 10 basis points would trigger the SAM rule. And in our opinion, the probability is very high that when the BLS publishes its unemployment report at, I think December 8th, next Friday, the indicator's likely to trigger the SAM rule and signal a recession is in progress as of the November model data. So what does that mean for investors? Well, if we are in recession, past recessions earning drawdowns have been the key issue that investors face. Every economic recession since 1957 has been accompanied by an earnings recession. And according to research published by D.A. Davidson and others, looking back at the past 10 recessions, The average EPS decline during each period has been about 29.5%. But if you exclude the two worst instances, which were the tech wreck and the great financial crisis, they're down 18.7%. Now, IBIS consensus estimates for the S&P for 23 and 24 are $221 and $246 respectively. But if 24 S&P op EPS were to instead decline by just half the average recessionary earnings drawdown, about 15% decline, that would actually result in 2024 earnings of about $187. And we think the odds are shifting dramatically in favor of a recession in 2024. And if they are, then valuations are truly going to begin to matter in the not too distant future. The problem is high valuations cap any upside potential. And if you look at valuations today, total market cap to GDP is about 166%. That explains why Warren Buffett's sitting on a record $157 billion in cash right now, because he can't find anything to buy at these valuations. And this is his preferred valuation metric. Now, it's well below the all-time extreme of about 210%, but it's still above its prior secular peak of 143%. And that was recorded back in March of 2000. In addition, the Shiller cyclically adjusted price earnings ratio closed right now at about 31 times as of month end November. The recent cycle high was 38 and change, and the historic average is about 17 times. So we're definitely in that top decile of valuations right now from a cyclically adjusted earnings perspective. S&P dividend yield is currently plumbing its historical lows at about 1.5%, while the price to sales ratio is at a very bloated 2.5 times. Now that's down from the all-time record extreme, which, basically back around the 2022 high, we were at over 3 times. And if you look back to March 2000, that extreme was 2.1. So we're above the March 2000 extreme on a sales basis. Price to books 4.3 times. That's below the 2000 peak of 5, but it's more than double the 2009 trough of 1.7. So it's kind of a ridiculous premium to be paying for liquidation value right now. To say the least, it does not appear that the market's pricing in an imminent recession. So we just want to bring this to everyone's attention. This is the bull market of 2023. The bull market that everybody's been so excited about. But contrary to popular opinion, it's been far less epic than meets the eye. One only needs to examine the price performance of the S&P 500 equal weight index to observe that fact. While the cap-weighted S&P is up 19%, the average stock, as measured by the equal weight index, is really done little more than T-bills. It's up 4.6% since January 1st. And it's hard to believe, but through November 30th, 72% of the constituents of the S&P are underperforming the benchmark, while 41% are actually negative for the year. So despite the torrid November rally, just a handful of hot mega cap tech stocks are really responsible for driving the performance of the major averages.
Hey, Jeff, we've got about 10 minutes, so if you can...
I'll be done in 3.
Give some time for Q&A. Thanks.
Absolutely. So investor sentiment is another issue that we're focused on right here. It has reached an ebullient level. The name exposure index, the 2-week moving average of survey responses from professional investment managers, that's increased from 24% at its October low to now 81%, a pretty fully invested number for pros. Also, if we look at the AAII weekly sentiment survey, that saw bulls jump to nearly 49% from 25% back in October, while those that are bearish have dropped below 20% from around 48% back in October. So the bull bear spread has jumped a full 55 percentage points. That's a record, by the way, from low to high in just 4 weeks, to positive 29.2% from negative 25.7% on October 30th. Almost an unbelievable change in investor sentiment. Our assessment of the market is really based on a model known as the Elliott wave principle. Elliott wave was an interdisciplinary framework that was developed by a guy named R.N. Elliott back in the 1930s. It utilizes concepts from behavioral finance, mathematics, and fractal geometry, and it's used to identify self-similar patterns in the price action of most publicly traded securities and broad market indexes in order to try and make probabilistic judgments about the current and future path of prices. Elliott really, there are only two modes. There's a motive mode and a corrective mode. And motive defines the direction of the trend. And he labels that 1, 2, 3, 4, 5 waves. Corrective waves are counter trend interruptions. They allow supply and demand to rebalance. And he labels those alphabetically A, B, C. Now, there's a number of different nuances to the science, but basically the diagram indicates what we're looking for to get a sense of how the market is likely to trade. So this next chart kind of gives you our long-term structural perspective. We think that the S&P 500 is in the very early innings of a secular bear market at super cycle degree of trend. And based on our long-term analysis using the Elliott wave principle, we believe that the 90-year advance off the 1932 low counts best as super cycle wave 3. And we think that topped at S&P 4818. So if that's so, then super cycle wave 4, a major correction that's likely to take around a decade to completely trace out its the full extent of this corrective process, is really just getting started. The last time we saw a super cycle degree, a corrective waveform, was back in the 1930s, and it retraced 78.6% of the prior advance. If we come anywhere close to that, we could see the S&P 500 trading down around 1,000 by circa 2035 is our time horizon. So that is kind of our long-term structural perspective. Where are we today? We think we're in the most bearish setup since January of 2022. We think the market is on the precipice of a third wave decline at primary degree. Within that process, it should be one of the most dramatic declines that we've seen in our working history, certainly in mine. I began my career back in 1990, and I think it'll be the most wicked decline of my entire career before it's done. Finally, there's a couple reasons that could catalyze this decline. There is the potential for an impending oil crisis. And 2 points I'd make is that US inventories are at 46 days right now. It's the lowest in 40 years, but world oil demand is at an all-time record high this year. And well, what are we seeing on the supply side? We're seeing cuts across OPEC. This has the potential to create a massive imbalance, a massive supply-demand imbalance that the US is not prepared to fill the gap on at this point. We're already at maximum production, 13 million barrels a day. It's an all-time record. So we don't have any spare capacity to fill that gap if it occurs. And where oil prices trade today at around $74 or so, leaves a lot of room for upside. And if that were to occur, it could definitely have a negative impact on the economy and the markets. The other issue that we think is a big issue is the impending non-banking crisis. These are shadow banks that are levered 10x what the overall banking system is, and they're unregulated. They face the exact same risks that everybody else faces in the credit market and liquidity constraints. And then finally, I'd say that one of the catalysts for that would long-term treasury yields moving up to their full potential. We think the breakout that we've seen above this 4.3 level, even though we've corrected back to about 4.25 from its highs, is just getting started. We think it's highly probable over the next decade we could see the 10-year treasury yield move up to 10.5%. Final thing I'd say is that we think the geopolitical environment is far worse than people believe it to be. We think it's highly plausible that China and Russia are working together to undermine the West in order to achieve their own independent foreign policy objectives. We put these Twilight Zone cartoons on the side just to kind of remind people of really probably the most epic episode ever produced of the Twilight Zone, which showed, an alien entity coming to the planet Earth, convincing us that they were very benevolent and they wanted to help us, kind of the same way China is trying to convince the world that they're benevolent and that they want to help and they just want to participate in the global economy. But in the end, the answer was this: to serve man. They gave us this book with their outline of what they were going to do for us, but it was in their language and we couldn't read it. When they finally deciphered it, the last comment was, "Mr. Chambers, don't get on that ship. The rest of the book, to serve man, it's a cookbook." Okay, we have to look through what the message we're hearing from the Chinese. They're trying to put us where they want us, but what they really need in order to survive is they need our technology, and the way to get it is to harness that from Taiwan, where 70% of the world's supply of semiconductors is produced. And there's no question that they have been developing the military capabilities to either blockade or invade Taiwan, and with the goal of usurping that technology and dominating the semiconductor industry. So with that being said, what do you do with your money? Well, we think preservation of capital is now key. During a bear market, you just want to avoid losses and ride them out. We think, looking at where valuations are, whether it be property, stocks, commodities, or treasuries, the only thing that looks cheap right now is cash. And you can get a 5.4% yield on a 3-month T-bill. That's about 60% of the long-term historic average of the US stock market. The other idea that we'd throw in there is gold. We think an allocation to gold of 20% minimum would be probably one of the best things people could do to insulate against all of the risks that we've put on the table here. So with that, I'm willing to take any questions.
Goodrich, do you want to?
Yeah, what's the view on Bitcoin?
Thoughts on Bitcoin, please be brief.
Yeah, I have no view on Bitcoin, so that's about as brief as I can be.
Any other questions here? Because there's questions online from Rob Colorino. What are your thoughts on our 2024 election and deficit management policy?
Deficit management policy, I think I outlined pretty clearly. I don't think there is a deficit management problem or policy. I think it's a problem, not a policy. And I don't think it's going to go away anytime soon. As far as the outcome, I don't think either of the leading candidates is going to be the next president.
Interesting. Yeah, Jeff, what I find interesting is that I think you kind of abandoned any sort of a fundamental budgeting process in 2008. I don't know. Is that correct?
I think that's right. I think you nailed it.
Everything seems to be a continuing spend as much money as you need to spend, right? So
absolutely.
There's a whole bunch of other questions, but can you talk a little bit about the impact of low-grade conflict? Like, it seems to be a lot of low-grade regional conflicts that are happening now. There's been like a surge of it after Afghanistan. And the most recent one, since we're here in Miami, is I've heard that Guyana had a huge oil find recently, and there's talk about Venezuela invading Guyana because they've been emboldened because Biden's importing their oil now. Any thoughts on that?
Yeah, I mean, I think that's certainly possible. The U.S. has basically kept the world peace, for the last, 5 decades. And, my guess is we're going to continue to do it, but to a lesser extent. I think the other superpowers are really pushing their influence with, Iran, Venezuela, all the bad actors, North Korea, this kind of loose alliance between China and Russia it's really the only way that they can shore each other up to stand against the United States. And, I think from that perspective, all these small regional conflicts are going to keep the U.S. distracted. And as the U.S. is distracted, I think Russia and China will take bigger and bolder steps to position themselves for their ultimate economic survival going forward.
And it actually this kind of leads to the whole G7 BRIC plus separation. And any thoughts on that? And of course, there was the Argentinian election, which is kind of a swing away from BRIC plus back to G7. I guess Argentina is abandoning their currency and moving towards the dollar.
Finally, right?
That's because everybody wants to be on the dollar, because there's so many dollars in Argentina right now, and the IMF is so benevolent to other countries.
Yeah, I
Any
don't
thoughts?
really have a well thought out opinion on your question. I can think about it a little more and get back to you. But I think that there's a shift away from kind of traditional, socialist sort of practices by some of these, tertiary countries into more, autocratic, approaches politically.
Thoughts on artificial intelligence, ChatGPT, machine learning?
Yeah, I'll tell you what I think. And I wrote a very, very detailed report about this back in June 1st, and it's in the archives of our newsletter. But I think that we're in the very, very early innings. I think artificial intelligence is something that we should really think about for 2040. Okay, that's when artificial intelligence is going to be really, really important to the economy. We're in just the infancy, the first inning, maybe the first few batters of the first inning. I think it's too early to choose the winners in artificial intelligence. And I think what's been delivered as, public artificial intelligence is, de minimis compared to what's really going on behind the scenes at places like IBM, who really has been the largest developer of artificial intelligence, since the concept was conceived of.
I think the intellectual property issues are huge. I mean, I don't see why Sony Music, who I think owns the Michael Jackson catalog, just can't publish new Michael Jackson songs that were created by AI. I don't know. Anyway, private market influence on alpha potential. Any thoughts?
Yeah, so I think everybody's trying to move to the private market because they don't have to look at a mark in the Wall Street Journal every single day, so they can sleep better at night. But all the private market really is a leveraged version of the public market. I mean, they used to call it the leveraged buyout market. Now it's called private equity. So I think what you really own is you just really own more risk with less liquidity.
Great. So, Jeff, great job. How can we see your deck? Are you going to distribute it to the group here, or do we need to email you?
I sent it to you. I emailed it to you. You can put it up on your website or send it out to everybody if you like.
So I will publish it today throughout the day, so people can download it. It's always great information from you, to get. We've got Ed Yardani next week. Ed's always optimistic, and he's been right on target for the last several years. It's amazing. So, sometimes it's just great to go with the Fed. You know what I mean? It's amazing. But Jeff, we love your stuff because it's so real anyway. So we're gonna move on. Jeff, thanks so much.
You're welcome.